Good evening. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. A warm welcome to our clients who are joining us on this evening's webinar on what I may say is a very dreary Melbourne evening to get an update on everything that's happening both in the global and domestic economy, along with what's happening in investment markets. And we'll have a detailed chat about the political environment and particularly what's happening in the US. We're absolutely thrilled to have James Holt, Senior Investment Specialist at Perpetual, joining us for this evening's webinar. Now, James is very well known to our clients. James has presented to many an evening function to our GFM clients over a number of years. I'll formally introduce James in a moment. It is unfortunate that we're running this evening's seminar via webinar, but this is a sign of the times. We're a very social company. As all our clients know, we like to run face-to-face events. But as a substitute for the face-to-face events, we've run a series of webinars this year which have proven very popular. We're going to run a couple more webinars before the end of the year, and we will continue the webinars into 2021. But it's also our hope that we'll be able to re-establish the face-to-face seminars in 2021 to see all of our clients in person. It goes without saying these are eventful times, particularly the last week, the US election. There's been lots of commentary and chat about the impact of the US election, both on markets and economies around the world. We feel blessed that we're having this evening's seminar and James presenting to our clients so close after the US election to dissect what we feel may be the implications of the result for the remainder of this year and into 2021. It's important to understand that this evening's seminar is general in nature. We don't provide specific advice via these webinars. If there is something that we discuss tonight and you feel like you need more clarification on the issue that was discussed, please contact our office and one of our advisors will be more than happy to talk to you about the subject matter that you'd like to discuss further. Now, in addition to James joining us, so the way tonight's going to work is James is going to join us in a moment. He's going to go through the formal part of the presentation with slides. As we always do during the registration process for the webinars, we ask our clients if they have any particular questions. Again, this time we were inundated with questions, particularly lots of clients want to discuss what's happening in the US. So in this evening's webinar, I've got Patrick Malcolm, who's a partner at GFM. Good evening, Patrick.
Good evening, Paul. How are you?
Very well, and how are you, Patrick? And I've also got James Maliaros, who is a senior advisor at GFM. Good evening, James.
Hey, Paul. Good to be here tonight, and looking forward to the session. It's always a great way to finish the year, but it's a pretty old bleak night in Melbourne here, unfortunately.
No doubt it is. So there you can see our standard disclaimer about this evening's seminar being general in nature. And as I said, James will go through the formal part of the presentation first. James and Patrick will then ask the questions on behalf of our clients thereafter. So to now formally introduce James, James is responsible for providing technical investment support to financial advisors and investors in Perpetual's equity funds. James has worked in financial services for well over 20 years now. He has presented to numerous audiences of advisors and investors and appears via many different media outlets like CNBC, Sky News and ABC. His articles appear in multiple publications, including the Journal of Investment Strategy. James is very well sought after in terms of presenting. So good evening, James.
Thank you so much, Paul, and what a pleasure to be back talking to GFM.
Good on you, James. I'll get you to fire away with the formal part of your presentation.
Perfect. Thanks very much. If you could just move forward one slide, Paul. We just sort of called it, effectively the election, COVID, recession, and beyond. And if you move forward one further slide, that's our general advice disclaimer again, which is just to reinforce that. Obviously, all the stuff that I talk about is very much general in nature. Really, Paul and the team are experts in personalising that advice. So thanks very much for that. I'll just move forward to the next one. Clearly, the Americans had a tough choice this time around. I think this cartoon summarises it beautifully. You had Trump there, a bit of a rough ride on the one side, And, Biden may have been boring and well beyond the age of normal retirement, but he was the return to normality character. There's no doubt about that. And look, in the end, I'll come on to a few moments what I think the implications of the election are. But I'd say a couple of things. First of all, Trump's style was too much for voters, even though 56% of people thought they were better off than 4 years ago. And they rated Trump better to manage the economy. And normally that's the most important election issue, but obviously sometimes just not enough. And I think this card really shows that return to normality that people were seeking. The creative destruction nature of his DNA, voters could only take so much. The election was much more complex. Biden himself is a moderate, but his party was campaigning for much more radical change on healthcare, the environment, the Green New Deal, undoubtedly, which you've read a fair bit about. And although Biden won, I can't overstate how badly the Democrats themselves did. Biden won clearly, without a shadow of a doubt. But if he hadn't been at the top of the ticket, it's entirely possible the Democrats might have lost this election. They didn't win the Senate, obviously, which is quite a big deal when a party's coming into the White House. But secondly, they actually went backwards in the House of Representatives. In the US, that's very unusual. If your president is moving to the White House, the coattails of the president's popularity should be enough to win seats in the House and win seats in the Senate, and that didn't happen. But America, remember, is very different. If this had been a parliamentary democracy like Australia or the UK, as we saw with Bill Shorten last year on a pretty big agenda, and Jeremy Corbyn in the UK, it's possible the Republicans might have won. But Trump himself was just too unpopular, I think, in the end, to win the presidency, although he got pretty close there in the end. So there's plenty of finger pointing going on over that. Of course, as you can see here in this cartoon, Trump himself doesn't think he's lost. It's well worth pointing out, Obama won 69.5 million votes back in 2008. Trump has won 72 million and counting. So he's won more votes than any other president in history, but he didn't win enough, obviously, as many as Joe Biden, who's got about 77 million and counting. Of course, the popular vote itself doesn't matter that much. What really matters is which states you win, a bit like winning seats here in Australia. You can lose the popular vote in Australia as well, but you might win the majority of seats like John Howard did in 1998. But this is turning out to be an almost perfect reversal of 4 years ago. Trump won Pennsylvania, Michigan, Wisconsin, and Arizona and Nevada. This time round, it's the reverse. It appears that Biden's heading to 306 to 232 electoral votes, which is an exact reversal of previously. Biden was a lot more popular with working class voters, blue collar voters, make no mistake about that. And although Trump clearly, he knows he's lost, the game really is he wants to stay in the game. He wants to continue leading a sort of a movement of Trump supporters, if you like. But he will be leaving the White House on the 19th of January without a shadow of a doubt. That's certainly happening. If you move forward one slide, thanks, Paul. Why did all this happen? I think in the end, Trump's fate was sealed when the COVID recession hit. And I mentioned this last year that basically Trump would get home unless there's a recession, because you can see the history here going back 100 years. Whenever there's no recession, presidents generally win re-election. But as you can see there in red, whenever there's a recession, presidents generally lose. George H.W. Bush, George W. Bush's father, lost in 1992 when there was a recession. Jimmy Carter lost in 1980 when there was a recession. Gerald Ford in 76, Herbert Hoover in 32. As long as there's a recession the last 2 years before the election, they always lose. The last president to defy that rule was Calvin Coolidge in 1924. So you've got to go back a long way to find that. What is remarkable to me is that Hoover got 41%, Carter got 41%, George H.W. Bush got 37%, Trump still managed to get 47%, far more than the previous losing candidates. So he was certainly, I gave him a sort of a 1 in 3 shot. I thought he would probably lose, but I think everyone's probably surprised how close he came to winning. It's really quite miraculous he got as far as he did indeed. Moving forward just one slide, but it was, from the moment we had a recession, I think it was odds on that he would lose. There are many implications, of course, about the way this election has played out, though. The Democrats will wind up winning the White House. However, they're almost certainly going to lose the Senate, as I said, and going a bit backwards in the House of Representatives. We will have to wait until the 5th of January to find out if the Republicans do have a Senate majority. Right now, the Republicans have 50 seats. The Democrats have 48. There's a strange rule in Georgia that was put in place many decades ago that if no Senate candidate won 50% of the vote, they would be forced to run off elections. Both Senate candidates in Georgia, there was a special election and a regular election. Neither of them won 50% of the vote. Therefore, they've both gone to a runoff election, which will be decided on the 5th of January. The odds of the Democrats winning both those Georgia seats is pretty low, based on history, even based on the recent election. More likely, I'd say the Republicans will win one, the Democrats will win one, but that gives the Republicans a 51 to 49 advantage. But if the Democrats did win two, the Senate will be deadlocked 50-50, and Kamala Harris would have to come into the Senate to break tied votes whenever those arose. But more likely, the GOP wins. It'll block a lot of the stuff that the Biden originally had planned, or the Democrats had planned. So I'd say, Nancy Pelosi took a bit of a gamble not doing a deal with Trump before the election. She wanted a $2.2 trillion stimulus. The Republicans said no, $1.9 trillion. Now the election's done, and if the Republicans keep control, that stimulus will not go ahead. The Republicans instead are looking more likely to do a $500 to $700 billion stimulus, so nowhere near as big as the stimulus that was planned before. Yet the markets have gone through the roof. And why is that? Because generally, markets do like it when government is divided in Washington, because nothing gets done and they can just get on with business. And you can see that on the following slide here, where if you look at the outcome, moving one forward there, Paul, to the next slide there, you can see the market. Republican Congress's growth's about 3%, markets go up 13.4% per annum. This is about 60, 70 years of data. A Democratic Congress growth's about 3.3. Democrats produce better growth, but the market returns are a bit lower, about 10.7%. And in a split Congress, the growth rate is lower, but markets go through the roof. Why is this? Basically because what markets are seeing is there's no new spending, there's no tax hikes though as well. There's a little bit of stimulus, but not too much stimulus, no new regulation, and the Fed will be forced to do more. They'll be forced to pump more money into the economy, and they think that's good for corporate profits and share prices. It's a perfect mix of a little bit of good and no bad. And also, strangely enough, it might surprise you, Joe Biden's quite happy with this, because Joe Biden, as I said, is a moderate Democrat. He's not a radical Democrat. I don't think he was signed up to the Green New Deal and those other issues, but his headache was going to be how would he restrain the radical members of the Democratic Party in Congress from forcing through policies that would get through the House, get through the Senate, and he felt as though he might have to veto them or try and restrain them in some way, shape or form. If the Republicans keep the Senate, he doesn't have to worry about that. Instead, automatically they'll be knocked back in the Senate itself. So, the Green New Deal probably would have, they would have shut down fracking and oil and gas. Those voters would have come back very, very angry in 2 years. That's less likely to happen now than previously was the case. And also Congress, I think the more left members of the Democratic Party were keen to add more justices to the Supreme Court. That would have been a toxic issue in America. Again, Biden has saved from all of these ideas. He won't have to face them, and that makes his job in the first term a lot easier to administer, rather than have to restrain his other people in the Democratic caucus. And you know what? In a funny kind of way, I think the designers of the US system designed it this way. Like it or not, it's partly designed to prevent one party or another getting too much power in the US system, and it spreads power through the system, preventing too much from happening. So I'll sort of leave the US there. I'm happy to come back to it in questions later on, but that's kind of a broad summary. So we're left with that 1 in 4 scenario of a split Congress, pretty good for markets. Markets have responded accordingly, and I think that'll continue to go up. Closer to home, if we look at Australia, 50 years of surpluses and deficits. This is as a percentage of GDP. You can see the latest budget. We've all become Keynesians again. We're spending like crazy. We had to do this until obviously COVID is eliminated or disappears, or we learn to live with it in some way, shape or form. We have 25.5 million people in Australia. Our population grows about 357,000 in the last 12 months to March, for example. 62% of that is migration and 38% is natural increase. Because we have no migration, most of our growth has disappeared. Even once we return to work, We're allowed out of our homes. We're able to go to cafes, which is now thankfully happened in Victoria as well as the rest of the country. It's not enough. We need migrants to grow the economy. We're a migrant nation. So to fill the gap, that's partly what the budget deficit is about as well, is to create jobs, stimulate the economy in a way that won't be happening in the natural order of things. And that's why the budget was very well received, but necessary to prop up the economy in the meantime. If we move forward one slide, you can see also there the immediate effect, I think, on confidence has been significant. You can see this is going back 50 years, the 82 recession, the 1990 recession, the GFC. Confidence falls quickly, but it does take a while to climb out of the other side. This time around, so far, and I do qualify it with so far, you can see COVID there, consumer confidence fell sharply, but it's bounced back much quicker than it did in previous downturns. Hopefully that continues to stick. And on the right-hand side, I've got RBA forecasts there, which continue to improve. CPI, you can see the numbers at the top there, a bit boring. GDP in the middle, probably a bit more relevant. You can see there gradually what the RBA is doing is they're finding that the rates of growth are not as bad as they thought, and the rates of unemployment they don't think are going to be as bad as they thought either. So growth was -4%, more likely to be instead of -6 as previously. June next year, 6% growth instead of 4%. So all the numbers are improving. And instead of that dreadful 10% unemployment rate expected by December, more like 8%, and then declining to 7.5% by June next year and 5% by December 2021. Much, much better than the 9%, the 8.5% that was previously expected. So clearly the budget's working, the economy is better than expected, the Reserve Bank's doing what it should do, and that's all improving the economy. And QE is really kicking in a very big way. So the Reserve Bank on Melbourne Cup Day slashed rates to virtually zero. They introduced a new band of QE. And also in the housing market, the Sydney auction clearance rates are about 75, 80%, probably better than many anticipated. And I think it'll take people a while to realise this because everyone expected with no migration, house prices will collapse. I would put forward a slightly different alternative theory, which is I think what the Reserve Bank is looking to do is, but by cutting rates low enough and introducing QE, they can actually make lower rates to the point where people realise, I think, over the next year, that it's actually cheaper sometimes to buy rather than rent. So I think the surplus housing that would normally be soaked up by migration might instead be soaked up by some renters. Clearly, also, the Treasurer allowed banks to take in the lending restrictions of banks. I think all of that helps to normalise the economy quicker, sooner rather than later. Moving forward again, Paul, to the next slide, just on COVID. And look, I was talking to the GFM team on Monday. I said I was quite bullish about the COVID situation. I had no inside knowledge that Pfizer was about to announce that they're bringing out a drug. But the reason for that was because, as you can see on the chart here, and although it's being characterised here by our analyst as 4 phases, really, if you look at the flow of the chart, it's really 3 periods we've been through. We had that first phase in March when Europe, called phase 2 here, but it's the first big bounce in coronavirus infections. We had that second one then in the US, and the third one is obviously what's being experienced right now. We had 3 phases or 3 peaks during the Spanish flu back in 1918-19 as well. So I don't think it's too unusual to think that this is to be unexpected. It took about a bit over a year for Spanish flu to work its way through. I think coronavirus is doing very much the same sort of thing. So I was probably more bullish that maybe we're getting towards the end of the COVID situation, or we'd learn to live with it, or something would come along. But the other reason is, if you listened in the last week before the announcement on Monday, there was a lot of chatter where a lot of very credible people were talking about a vaccine being available within weeks, not months. It was quite significant, I thought. And the government, when they announced that acquisition of new doses last week, they talked in weeks rather than months as well. I thought that was quite significant. So I wasn't enormously shocked by the news on Monday. I thought it was coming in the next few weeks rather than the next few months, that something would be announced. What I was surprised by, pleasingly, because there's been no COVID vaccine ever developed, even though COVID has been around since the 1960s, I was pleased. Obviously, it was very quick, but secondly, it's 90% effective. That's amazing. Our flu vaccines generally are about 60% effective. So to have a vaccine for COVID that's 90% effective is truly amazing. And lastly, no side effects. Normally, there are people who suffer or there's some sort of side effect or whatever. Very pleasingly, there's no side effects to this particular vaccine. So I think that bodes very, very well also. Moving forward to the next slide, in terms of markets, I think there's a couple of things. First of all, clearly the Fed's done a pretty good job. Look, I think that the Fed's always going to create bubbles when they print as much money as they have. Look at the money supply there in the US. Go back 40 years, we've never seen the money supply grow as rapidly as it has done in the past few months. They're absolutely printing money like it's going out of fashion. However, I think they had no choice. It will create some bubbles in the system, but better to be safe than sorry, and better to be dealing with a few bubbles in the system and deal with those separately rather than face a complete collapse in the economy. But if we go forward one slide, I think one of those things that will be evident over time, Paul, if we just go to the next slide, which is basically high yield bonds, high risk bonds, if you like, and also the level of corporate debt. The problem coming into this crisis was not that consumers in the US had too much debt. I think they were fine. Our consumers in a pretty good spot as well. The problem in the world has been too much corporate debt. And you can see that's what the grey line is showing you there. The corporate debt rises as we head to a recession. You can see there in the grey shaded spots, a recession there, corporate debt rises. We have the recession and companies then delever. They reduce their debt on the other side. And normally also what happens is people who own high risk bonds are increasingly paid compensation in the form of higher interest. That's the green line, which goes up when corporate debt peaks. That's the way it should happen. Instead, what we're having in this case is the corporate debt, the grey line, you can see there has gone through the roof. In fact, we've never had this much corporate debt before. And yet the compensation for owning that corporate debt has not been that high. And partly that's because a lot of the money printing the Fed is doing is going in and buying these sort of corporate securities. Now, that's, again, fine in the short term. It's saved the economy. It's saved people's jobs and so on. But long term, it does create this problem of zombie companies. What would normally happen is that interest rates rise, the companies with too much debt or bad business models go out of business, and then that's the heart of capitalism, creative destruction. It's what you generally need. That process has been halted or paused in 2020 because of the intervention of the Fed. And as I said, that's fine in the short term while we're desperate for growth. In the longer term, it's a problem. If we don't solve that, we wind up becoming a kind of a European or a Japanese low growth system, because that's where they have two bad debts and zombie companies that have gone on for many, many decades. Hopefully Australia and the US won't wind up in that position. And also in terms of irrational sort of exuberance, if we look to the next slide, you can see there, I think this really sums up what's happened in Australia the last 5 years. These are all of the what are called GIC sectors. This is just the different sectors of the economy: IT, healthcare, industrials, telcos, and so forth. And you can see on the left-hand side, most sectors are about the same price. IT and healthcare on the left-hand side of the 2015 chart generally are a little bit more expensive. The numbers there are PE ratios, the valuation, if you like, the price of the earnings that people are willing to pay. And they're a little bit higher for IT and healthcare always than on the the consumer and the other financial stocks on the right-hand side of that 2015 period 5 years ago. But on the right-hand side, we can see what's happened here is that the sectors, the growth sectors like IT, healthcare, the blue sectors, have gone through the roof. The valuations have absolutely exploded. The value sectors on the right-hand side haven't changed that much. Value stocks, the PE ratios don't necessarily change that much. They just earn money, they grow, and they deliver dividends over time. It's the growth sectors where the PEs rise a lot. That's called a re-rating. And that re-rating process has made them a lot more expensive, as you can clearly see in the chart. But also what tends to happen in markets is that after a re-rating process, you then get a de-rating process. Those PEs fall back down to earth again. In some respects, the markets are just continuously moving from the 2015 to 2020, then back to 2015 and back to 2020. And that's what causes a lot of the volatility in the market. The growth sectors become expensive, then they fall back down to earth again, and so forth. And that's what often creates this big dispersion between value stocks, undervalued stocks, and growth stocks. Even though they might be good businesses, they keep on kind of falling back to earth again. And if we take a little bit of a close look at one of those sectors, IT, you can see here what's happened is that and this is a few months ago now when we did this analysis back in July, but you can see there, and there's a bit going on in this chart, but if you look at the top table, the market valuation of all of the technology sector was $59.8 billion, just shy of 60 billion, probably about 70 billion now. Computer share was 7.3 billion of that 59 billion. It was about 15% of the market. But if you look at the second column, forward earnings, computer share was almost half the sector earnings. $417 million was made by one company, and all the other companies in the tech sector made about $520 million. It was 15% of the value, but 50% of the earnings. So if you take computer share out, the tech sector in July wasn't trading at 63 times, it was trading at 101 times because one company, computer share, on a much lower PE, made the whole sector look cheaper. And it really highlights how expensive, if you like, the whole IT sector was. And I won't go through all of the detail in the second table below, but the point of that table is that the earnings growth, both to June 2020 and December of last year for the tech sector, was basically negative. So here's the ironic thing, is that earnings in the tech sector were going backwards, especially once you stripped computer share out, but the shares kept going up. So our point here is simply that just because shares are going up, people think it's a must-buy company. There's something fabulous going on with this company. Often the earnings are going in the opposite direction. They're often going down, or there's no earnings at all. So we've got to be very careful about great ideas that might be worth a lot of money, but can't necessarily be backed up with valuation at the end of the day. And humans are prone to this. We go through this all the time. 100 years ago, we put enormous valuation on railroad companies to the point where railroad companies made up the entire stock market. And today that looks a bit silly, and most of them went bankrupt. The tech sector 20 years ago, we're having a bit of a repeat, if you like, of the tech sector boom of 20 years ago. Many companies will survive and thrive, but a handful are not that great. And if you look at the overall sector earnings quality, I don't think they really justify the enormous valuations the entire sector has been put on. And we've been here many times before. If you look forward to the next slide here, the same thing's going on in the US. And here's a little phenomenon for me, is that Apple, Amazon, and Microsoft, and they're good businesses, but you can see what happened. They're in a bubble 20 years ago. Everyone agreed that the tech sector was in a bubble. They traded at 45 times cash flow, those three companies, back in 2000. That's the peak on the left-hand side. And they're back there again today. But here's the question. If they were a bubble back then, why aren't they a bubble now at the same price? Especially because if you think about it, the reason these companies get these high valuations is because of the huge future growth prospects. But the point is, they had better growth prospects 20 years ago. Apple, Amazon, and Microsoft were smaller businesses, and they grew for the past 20 years. They became large businesses, but now that they are the big businesses in the US economy, it's hard for them to grow much faster. In fact, their growth is slowing down. So why are we putting a high growth multiple back into these businesses? Why are we assuming they're going to grow faster than ever before when in fact they're obviously slowing down compared to 20 years ago? They've had their growth. And of course, more importantly, in between, even though they did fulfill their destiny, they did grow very rapidly over the past 20 years. For some reason, the market decided they were worth 45 times their cash flow back in 2000, but only a fraction of that a few years later. And they stayed low until recently. So again, we've got to be wary of paying anything for a company, too much for a company, saying that if you like growth at any price, just because it's growing doesn't necessarily mean it's a fantastic business to be in, even though it looks very glamorous and has done very well in recent times. So moving forward one slide, we can see there in Australia, the story is very much that we go through these periods. You can see there in the late 1990s and the late 2000s, they're the circle periods. And of course, the last few years, look at the scale with which those growth companies boomed. They grew very quickly. They rose much faster than the black line, the darker line, which is value stocks. But notice over 25, 26 years, they've never actually caught up. Value stocks, in our view, like Warren Buffett, we think value stocks generally win in the long term. They have provided better returns, but there have been many times when growth stocks have got close, but just as they get close, they fall away again, as you can see there in 2000, as you can see there in 2008, and again, maybe more recently. So we're just very worried about putting too much valuation into those stocks that could fall away. And also the movement, if you like, between growth and value sectors is very, very cyclical. So again here, all I've done here is these are rolling 5-year returns. At any point in time, this is the 5-year return of value versus growth. Sometimes value is doing better, like in 2000 after the tech bubble burst. Sometimes growth is doing better than value. That's when the line goes down, and that was peaking just before the GFC. And then 5 years later, value is back to peak performance in 2015. And of course, as we see now, growth stocks, because of those IT sectors, the healthcare sector, have outperformed value, and that's why they look so good today. But be wary that those growth stocks have done about as well as they possibly can. They've reached the point in the cycle where we think there is a rotation back towards value again, just as there has been historically over time. And lastly, if we move to the next slide, we think that's particularly important because this is usually the time for value stocks to start doing well. This period so far does remind us a lot of the GFC. And as you can see there, the first phase of the GFC, when stocks were falling, people thought value stocks would do well. Surprisingly, value stocks fell about 55%. That's the orange phase one of the GFC. Growth stocks actually held up better. This was the opposite experience of the dot-com bubble bursting. Dot-com burst in 2000, value stocks did better right away. The mystery was, why is value not doing as well in 2007 to 2009 as the GFC is hitting? And so everyone poured their money into growth stocks right at the bottom of the market in March 2009. From then on, however, value started outperforming. And as you can see there in the two blue phases, whether you look at it as GFC phase 2 or recovery phase 3, whatever, or both those periods together, once the market bottoms and recovery comes, value stocks tend to perform better. And you think about it, the companies where value stocks are most heavily weighted are things like resource companies, energy companies, the banking sector. They've bottomed during the recession, but they recover faster because they're so much cheaper to begin with. And so value outperformed growth by about 181% from 2009 through to 2015. Moving forward, just one more slide. For us, therefore, I think there's probably two key things to think about. First of all is quality of businesses. So we want to own high quality businesses. And you can see here, we put companies through 4 quality filters. The first one of those is, has it got quality products? Has it got a good structure, operational efficiency, a competitive landscape? If it has, we want to think about those companies. Secondly, we want to look at their balance sheet. Have they got conservative levels of debt? It doesn't seem as important in this period where interest rates are virtually zero to have not to worry too much about debt. But believe me, there will be a period where corporate debt matters again, like it has done in times past. So for us, if a company can't pay its interest bill 3 times over, we don't consider it for investment. That's like backing a household where the level of household debt repayments are more than a third of their income. It's just too high to risk investing in a company with that much debt because we don't know what will happen in the full cycle. Sound management, it seems obvious, but you're amazed how often management does not fulfill expectations. We have to meet management and trust that they will do the right thing at the right time by our investors. And lastly, recurring earnings. We need to have proof of a track record, a capability of delivering earnings growth over time for us to consider a company for investment. And then lastly, what all this means from a company point of view, if we just move forward one slide, is that, we can look at companies that have got excess assets or might be coming into a takeover or recovery situations or cyclicals or resources. All these things sound very different, but if you think about it, right now, there's a company, which we added to during COVID, Event Cinemas. You've probably all seen an Event Cinema. Event Hospitality owns those cinemas. At one point there during COVID, the company was valued at $1 billion. The problem, of course, is it has $2 billion worth of assets. So we bought as much of it as we possibly could. Event has recovered very dramatically in recent days as the prospect of reopening comes into play. But it shows how short-sighted the market can be. Clearly, at some point, we're going to reopen the economy. People are going to be able to go to cinemas again when a vaccine was developed. We've got to value these companies in the long term, not just over a very short period of time. And when the opportunity to buy more of Event at almost 50 cents in the dollar came up, we certainly took the opportunity to do that. And they have a very good balance sheet as well. You think about recovery or turnaround situations. I think that's going on right now with Boral in Australia. There's a new CEO who's looking to offload the US assets and keep the fantastic high quality Australian building business going. Fletcher Building, you probably noticed, has really rallied very sharply in New Zealand. It's really turning itself around. Cyclicals are simply companies that are at the bottom of their normal business cycle. Incitec Pivot, right now, there's not much demand for fertilizer. Fertilizer prices are very low, and therefore the revenue of Incitec Pivot is very low. But that's the time to buy it, not when fertilizer prices are high and fertilizer profits are very high and Incitec's profits are very high. That's the time to sell. But usually when it comes to cyclicals, you buy them at the lows and you sell them once the business cycle is improved, once we get to the peak. Resource companies, again, here you want to buy, again, an asset which is trading at a fraction of its true worth. I think nothing exemplifies that better right now than Oil Search. Oil Search, again, has done pretty well as the prospect of a vaccine appears the last few days. But Oil Search was once a $10 per share company, and it has fantastic assets. But recently, it's traded as low as only about $2 or $3 or thereabouts. So it was trading at a fraction of its long-term value. A great opportunity for us to buy more for our shareholders, and I think that'll be rewarded over time. Mature companies with a good dividend or relative PE, Origin Energy for us pays about 6.5%, the sort of yield the banks used to pay. Good exposure. Whether as we transition from a coal-heavy economy to renewable energy, all of the energy transmitters like Origin will be part of that. So we think those companies are well placed. And lastly, growth companies as well. So Premier Investments, we think it's a great business. Smiggle, Peter Alexander, all those sort of businesses, very well run into Melbourne, of course, by Solomon Lew. We think it's a fantastic business, probably the best retailer in Australia. But his ability not just to run his own business as well, but he's got hundreds of millions of dollars in the bank on the balance sheet, no debt, which you can use to sort of pick off, if you like, the best retailers, I think, as recovery takes hold. So we think they're the sort of companies that investors will do best by in this sort of environment going forward. So thank you very, very much for your time. I hope that's been a benefit. I've been a little bit over half an hour, but that's kind of what we had planned. But happy to switch now to questions.
Okay, James, thanks very much for a great presentation. That was great, and thank you for a very insightful topic and some great slides as well too. Look, I want to go back to the first question, back to the US, and just ask a couple of questions around that, if I may. Clearly, the election result was called last Sunday. Okay, Biden accepted his president-elect, but I just think that, you know, obviously there's still another 10 weeks to go before he's sworn in. Okay, Trump's still got the keys and unlikely to give them back. So, and there's a whole bunch of legal possibilities happening at them, you know, that could happen. So do you think over the short term, given that a little bit of uncertainty may cause some market volatility up until, you know, the election result is officially declared?
I think one of the great things about the US system, it's a very good question, by the way. And look, you never know, you know, what nonsense might go on, given he's a very unusual president. But look, I think it's worth noting that, again, the founders of the American system always feared a demagogue or feared someone who would try and take control of the system. They're trying to get away from the UK. They're trying to get away from monarchy. And that's why there's so many checks and balances in the system itself. And whether he likes it or not, there's no way he can stay beyond the 20th of January. So he is out. But also, he does have to think to his legacy. And, you know, I know Trump's a very unpopular guy, but he did achieve a lot, especially for conservatives, for the Conservative Party, for the Republican Party, for his supporters in the United States. And a lot of people are trying to say to him at the moment, look, just be aware that if you go out in too ugly a fashion, you actually could endanger your legacy, and you could actually lead to a lot of the decisions that people liked, you know, being overturned. There might be justification for stacking the Supreme Court and things like that. So I think he's got an eye to that. And look, I think a large part of it, to be frank, is about building the Trump brand and about building a movement beyond the White House. Look, I don't think he'll ever concede defeat, but that's part of his plan to move into the next sort of phase. But, you know, I'm not even 100% convinced that if he'd won or lost, he would still see an opportunity to build. I know Pippa Malmgren talks, who has worked in Republican administrations, has talked about the concept of TNN, Trump News Network, being formed potentially in the next few years. I wouldn't rule it out. You know, anything that stays in the headlines, that keeps him in the game, in some respects, he's better off having tens of millions of supporters and being out of the White House than being in that whole time. So he might have a crack in 4 years, someone else in the family, or he might endorse someone who supports Trumpism. But he wants Trumpism to stay alive, and he wants it to be a continued thing. And you can't do that if you kind of wreck your legacy at the same time.
Okay, thanks, James. Patrick?
Thanks, James. Will Twitter survive without a Trump presidency, James?
It's a very good question. It's the funny thing is, obviously, the split result in the Congress means that any sort of regulation of the big tech companies is possibly on the back burner now. So that's partly why the tech companies have rallied so hard. Look, I think they all love it, right? It's all a big game, you know, and obviously they've put conditions and comments on his tweets in more recent times. But without him, I mean, you know, it's the show's just not there, is it? You know, so
good. You answered my joke question as a serious question, James. My serious question was, you spoke about a split Congress and how good that's been for share markets in the past, but we are in different times. Are you concerned that with a split Congress that may affect initiatives around spending and taxation and infrastructure that may be needed to help the world in these, or the US and the world in these times?
Yeah, look, it is a good question. I think maybe the stimulus is not as necessary. Look, I think the fear was that a lot of the Green New Deal stuff might have been a bit wasted. I feel as though a lot of the stuff that is required is going to occur anyway. Necessity is the mother of invention. We didn't know we needed Twitter. We didn't know we needed Facebook. The government didn't create those things. Those things were all created by private individuals who realized what people wanted. Tesla is not a government institution. It's a private company. You know, it takes the American government trillions to put people into space, but somehow SpaceX and these other privately run companies can do it for a 20th, a 30th of the cost of the US government. So I think actually we are transitioning to a low sort of emissions world, not because you know the Democrats plan to spend $3 trillion, but you know what? Because solar panels are so good now, and they're increasingly becoming cheaper than oil and gas and coal and those sort of things. So I think the transition to electric cars, to cleaner energy is all going to occur anyway, because the technology's improved so much and it's backed by really, really good entrepreneurs. I think a few of them will go bankrupt at the same time. But remember, the railroad entrepreneurs went bankrupt. Some of the internet entrepreneurs 20 years ago went bankrupt, but the internet stayed with us, and the things they produced stayed with us. You know, I don't want to sully it by saying, you know, that Christopher Skase built you know, a few hotels in Queensland and went bankrupt and disappeared off to Spain, but the hotels stayed. It's much the same with this technology and other things as well. So I think a lot of the infrastructure necessary is being built and will continue to be built by the private sector anyway.
Thank you, James. James, this is a bit confusing with two Jameses.
I know. I often get Jimmy.
Yeah,
You know?
yeah, so do I sometimes as well. Look, I just want to sort of follow up on some of the stuff you talked about, specifics. Clearly, Biden's got some key initiatives that he wants to do, things that he wants to achieve, and they obviously revolve around clean energy, as you were talking about, affordable healthcare, you know, massive infrastructure spend. You know, we know the American economy and the country needs massive infrastructure spend just to get things back up to scratch again. What do you think in terms of will be some of the winning, some of the industries that will win, some of the industries that will lose in America? And do you think there'll be sort of a flow and effect to some of the Australian companies here?
Yeah, it's a good question. I think the thing with the split result, I think the winners that we expected a few weeks ago are going to be very different. So I don't think the clean energy companies and similar businesses, a lot of the solar companies really rallying into the result. I still think they'll do well as a business anyway, but people are loading into those stocks and have sold off quite sharply. And I hate to make it sound like a style-based thing, but I think not so much Biden's win, but the Pfizer vaccine probably brings on the recovery trade much quicker. And so I'd say, rather than saying, well, this particular industry or sector is going to be a winner, because I think, you know, they were kind of going to go their own way and people have put trades on them ahead of the election. I think with the most important thing from an investment point of view about not just the win, and the split Congress, but combined with the vaccine, is that we're going to see this massive style rotation. I think that's the most important single thing in markets. And as we're sort of saying before we came on the program, that effectively, momentum, which is where you just buy stocks because they're going up, which is a completely valid strategy, had its worst result in 21 years, ever since it was measured first, just a few days ago. Value had a pretty good result as a result of it. So I think all it's done is that, even more importantly than the split Congress plus the vaccine, has simply, I think, will create this enormous pro-cyclical trade, whatever it's called. And that's going to be the defining event of the next probably 2, 3, 4 years, rather than a particular sector industry, which I think will just go through its natural gyrations and so forth, as those sort of technologies are developed. And there's, I think, unfortunately, not much implication for Australia. Our correlation with Chinese growth is now more important than the US. We used to be about 70% correlated with the US. We're now about 30 or 40%. And we used to had no correlation with China. We're now about 60 or 70% correlated with China. So, it's not when the US sneezes, we catch a cold, it's when China does. When China sneezes, everyone's caught a cold, of course, as it turns out in the last 12 months. But exactly.
Okay. Patrick?
James, you focus very much on corporate debt in your presentation, but I think I've got to ask about government debt as well. The governments have never held this much debt ever. And then we layer household debt on top of that as well. So it's debt, and debt. What do you think the implications are for markets with the level of government debt on top of corporate debt and household debt as well?
Yeah, look, it's a good question. I think I don't think it's a problem for today, right now and today, but I think you're right. It will become a problem in the next 2, 3, 4 years as we move beyond the crisis into a full-blown recovery. My suspicion has always been that, in South America, the way you get rid of debt is you just don't pay it anymore, you default. In the US, they don't default, they don't stop paying interest on debt. What they do is they create inflation. And I think the best guide is that in some respects, what's going on now may sort of have correlation with the late 60s, early 70s, where effectively America, you think about the correlations. They had the Korean War, they had the Vietnam War, they had a massive social welfare program called the Great Society in the 1960s. And at the end of it all, they just said, how do we pay for all this? They just let inflation run. They printed money to pay for the deficits. They let inflation run. And of course, we had 6-7% inflation through the 1970s. And by the end of the 70s, we had no more problem because it had all been inflated away. That's the neatest solution of all. Now, only the US can get away with this because they have what's called the exorbitant privilege of being the world's reserve currency. But I suspect that may be used in the end to kind of print away their problems. So I think even though there's a split Congress right now and there's no big budget deficit, I think if you look forward to the future, money printing, maybe some deficits, all of that plays into resources, energy, mining, metals, gold, all those sort of things will tend to go up, like we had in the 70s. I think it's kind of the only way out. I don't think the US will ever default technically, but some people see inflation as default because you kind of say, well, I'm still paying you interest on your bond, but it's worth 10% less this year because I've created 10% inflation. Exactly. Yeah. But yeah, very important. I think question we're all going to face in the next few years.
James, let me ask you a question about COVID. So clearly we saw the first thing that Biden did. He convened a whole bunch of really smart people to talk about COVID and try and get that under control. I just read somewhere in the document that I've got here, there's about, a record 143,000 cases, the other day in America. So, clearly a problem. I know the vaccines come, but, we know that by the time it's mass produced, distribution, logistics, a whole bunch of issues around that. So clearly Biden's prioritized fixing up the issues around COVID. He's got some ideas of what he wants to do. Do you think that he may have to go through phases of partial lockdowns? And if so, will that affect the US, the recovery in the US economy? So we're seeing some really good numbers, some corporate earnings coming out of America. So the numbers look good, corporate earnings look pretty good, but to the extent that if he's forced to close down parts of the economy, And can he do that? And, and do you think that's going to have an effect on the US economy going forward and therefore the rate of recovery?
Yeah, I think that's a really, really good question, James. I think also, I think there's many factors here. I was talking with a friend a few months ago about the fact that there's a paper written in 2016 saying that that the US would never handle a pandemic well because of its decentralized nature. You've got a weak federal government, very powerful states. They hate being told what to do. That he said, no matter what the pandemic preparation was, it would be a disaster. And sure enough, it's turned out to be that way, right? And H1N1 was not that great a few years ago as well, under a different administration. So regardless of politics. But you know what? The US is going to wind up producing the first vaccine too, because of that same deregulated system that allows creativity and chaos, has gotten them the worst outcome, but also gives them the first drug to mass produce. I think two things with Biden. First of all, I think he's loath to do a lockdown, but maybe some state governments will. Some state governors may introduce some. Maybe he'll do some sort of a lockdown or recommendation, but I doubt that he'll actually rigorously enforce, and he can't really enforce a lockdown nationally anyway. It's really very much at the behest of the states, like it is here in a way. I reckon what you may see instead is if Biden does something, he'll use the bully pulpit of the presidency, which is every president has always used, and it's completely appropriate, to tell people to wear masks. I think you'll see mask wearing, which is very low in America. It's only about 30%. I think he'll encourage or whatever in some way, shape or form, or direct the states or encourage the states or incentivize the states to use mass mask wearing as a way of slowing. Maybe some states will do shutdowns to prevent sort of transmission as well. I don't think that's going to come from Biden. But the other thing as well, and this comes back to also your previous question and some other ones that were asked about stimulus, there is hope in the sense that Biden was in the Senate for 36 years and is a fantastic deal maker. One of his best friends is Mitch McConnell, who is the leader of the Republicans in the Senate. So I think, I don't think there's going to be a big $2 trillion stimulus, but I reckon there might be a pretty sizable $600-700 billion stimulus, and maybe even getting up towards $1 trillion, which will probably help to tide them through any lockdown or whatever. They'll do a deal. They'll meet at the White House. They'll, all the usual stuff. But that plus a masks policy and maybe the states do a lockdown, I think you're probably looking in that sort of zone or area, and that might be enough to kind of, be a bit of a reset for the US.
Okay. Very good.
Apparently, the rumor was, James, that when Obama was president, O'Connell used to call the White House and just say, "Get me Joe. I don't want to speak to Barack to get things done."
That's right. He's, Joe's a great guy, and he's probably a little bit past the. He's not at his best. I could put it that way. He turned 78 this month, but he is a beloved figure, and people like dealing with him. And 36 years in the Senate certainly buys you a lot of friends. And he's got a lot of friends in the Republican Party as well as the Democratic Party. And I think that probably this is his time, to be in the White House and to, I think, and voters vote very tactically. They knew exactly what they're doing. They wanted Biden as president, but they weren't willing to give the Democrats full control. I think it's one of the interesting solutions, isn't it? That you tactically vote deliberately to kind of restrain at the same time as you endorse, and that's exactly the way it's turned out. But I think it's an ideal time for a hugger, a healer, a handshaker, a backslapper like Joe Biden to be there.
Good. Can I ask a question about China, James? It's hard to believe there was a trade war before COVID. All doesn't feel that long ago, but there was.
Yeah.
Do you think that the trade tensions will flare up again between the US and China? And if they do, I guess, what are the consequences for Australia from that?
Yeah, look, it's very interesting. I think the trade war will stay in place. It might be less dramatic. I think the tone might be better, but it's important to realize that although Trump kind of called the trade war or the Cold War Mark II, whatever you want to call it, the Democrats have been enthusiastic supporters and they fully endorse. If you think some of Trump's speeches and some Republican speeches have been pretty tough, just look at what Chuck Schumer, the head of the Senate Democrats, has said. He's said worse things than the Republicans sometimes. So there's a unity ticket. They know that Democrat jobs, a lot of blue collar jobs, have been lost to China, and therefore there is a lot of it's a bipartisan thing, the agreement with the trade war, not the trade war in its current form, but the relationship China and the US had before Trump came to power and after has completely changed. They don't see them as sort of partners. They're now definite rivals. They're onto the IP theft and things like that, and they don't want to see a return to how things were before. So it's a bipartisan issue.
Thank you.
Okay, James, for the last question, because we're just about out of time as it is anyway. Look, let's get closer to home. Clearly, look, I think, Australia's had a sort of fairly, good success story in getting through the difficulties of COVID. Obviously, Victoria had its challenges, and we got, seem to have got through the worst of that and coming out the other side. So what's your gut feeling? I know you talked about some numbers in relation to the graphs that you did, but what's your gut feeling about how quickly our economy can recover? Obviously, unemployment is probably going to be the lagging issue, I think, and that's really, really important that we get that sorted. But what's your gut feeling about how quickly our economy is going to recover, and how does that sort of affect, the rest of the economy, and particularly sort of business, particular industries out there?
Yeah, look, I'm fairly bullish. I think we'll actually have a pretty good recovery, and I think that's kind of already half baked into the numbers anyway. Only a shock event or a complete discombobulation of our situation would really upset that. Clearly, our relationship with China is not great, but apart from frozen food and barley and a few things, if you look at these industries, and I don't want to disparage or diminish them in any way because they're all valuable industries, but they're sort of $1 billion or $2 billion or whatever. China's very carefully picked on industries that aren't that important or won't really upset the relationship. What's really important is Australia is in some respects, like a gigantic hedge fund. We export, 1 billion tons of iron ore, which can be worth tens, if not over $100 billion. We're the biggest gold exporter in the world. We export coal. Obviously, coal's under pressure, but they've got their own supply as well. So the big traders, iron ore and gold and things like that, those things are relatively unaffected by the China relationship. Just getting back to the question that Patrick was asking earlier. And I think outside of that, once you look at the budget settings, the RBA, I think we've been very well managed from a macro perspective. And also, the thing I've been most worried about is migration. We're a migrant country. 2/3 of our population growth comes from migration. If that had been permanently turned off, I think we're in trouble. But I think if we use this stimulus to get through the next 12 months, we inoculate the country by the middle of next year, I think we can be in a position to open up to migration again. And I think we'd welcome, and I think the people will be lined up waiting to get back into the country again, and I think because we're a great destination, to be. So I think that'll be getting through the next 12 months, and I think the signs are good. Once that process starts again, our growth story continues on from there. We've got China, we've got migration, we've got a fantastic. We were talking before about how bad government debt is, but in Australia, we're one of the few countries with low government debt. We can afford this bailout for the time being, at least. Not for 10 years, but certainly for a year or so.
Okay, that's fantastic. That makes a lot of sense. Paul, I think that's it. We've sort of gone through the questions that our clients had pitched to us. They were the main ones. I know probably a lot of our clients will have follow-up questions, which we'll be happy to answer. But I think from our perspective, we're done. If you want to sign off, it'll be great.
James, thanks. So we've got about 2 minutes to go. And as we're nearing the end of 2020, for a little bit of fun towards the end of tonight's webinar, we thought we'd we'd get our crystal ball out and we'd make a prediction into 2021. So I'm going to ask each of the panelists, and it can be a prediction about anything. It doesn't need to be about financial markets or about the economy. It can be. But I'm going to ask each of our panelists now for a prediction into 2021. So let me start with you, James Holt. Do you have a prediction for 2021?
I have a feeling that there's a vaccine coming next year. And I think the Swans will win as well after a long drought.
James,
what a stitch up. What a stitch up.
I like it a lot, James. Okay, James Maliaros, you're next. What's your big prediction for 2021?
Yeah, here we go.
I have it written in order. Okay, so look, I think we'll do the three-peat and we'll be known as the best team of the last 50 years. Simple.
I shouldn't have asked you, James. Okay, Patrick, your second last. What's your big prediction, the crystal ball for 2021?
I'm going to make two predictions. Now, this is my favourite week of the year. It's Masters Week. It's the most important week of the year as well. I'd like to think an Australian would win, but I don't think they're playing well enough. So I think DeChambeau is just hitting the ball a very long way and will win. And I think there's going to be a little bit of a reversal of the trend of international shares beating Australian shares. I think next calendar year, I reckon Australian will beat international. Now, Paul, you've got to give us something.
Okay, well, I'll give you. I've got two predictions as well. I'll start with the Australian share market theme. My favourite stock, I've named my dog after it, CSL. I think it'll continue its meteoric rise into 2021 as a mass producer of the COVID vaccine.
You're calling a $400 share price, Paul?
I won't go that far, and this is just general advice. And then my second prediction, maybe a more serious one. I think Anthony Albanese will be unseated as the leader of the Australian Labor Party, and I think Dr. Jim Chalmers will become the new opposition leader. So that's my prediction. Anyway, we're right on 8 o'clock. James Holt, that is, on behalf of James, Patrick, myself, the GFM team, and all the GFM clients, it was a shame we couldn't see you in person this year. You make a big effort to come down from Sydney each year to see us and to see our clients. So we have missed you this year, but I think the timing around tonight's seminar, the webinar, was fantastic, and you were particularly insightful. So, James, a very sincere thanks on behalf of the team and all of our clients.
Thanks, James. Thanks, everyone.
Wonderful. Thank you. Great to talk to you again.
Thank you, James.
Take care.